Professor Siegel, it was an up and down day on Wall Street. Got a rally in the Nasdaq of as much as 2.5%. It closed down a third of 1%. Today was supposed to be a comeback day after a really ugly day yesterday. What does all this action tell you about what is getting priced in?
Well, I mean, as I said, 3 or 4 weeks ago, I thought that Nasdaq would be in a bear market and S&P in a correction, and I think we're there. I'm beginning to find it interesting from a longer-term perspective for long-term investors. I think the bigger problem, more than even energy prices, is that the Fed does not just use Ukraine as an excuse not to raise rates, because we have a very fundamental inflation problem that goes way beyond oil prices, and it would be a big mistake. The medicine will just have to be stronger down the road if they don't start raising rates and controlling the inflation. I think we're going to get a very bad print coming up on March 10th in a couple of days. I think almost 8% year over year, and believe it, I think we could get to 10% year over year on the headline. And to me, it seems silly to debate, should we go from 0 to 0.25%, 25 basis points, or 0 to 50 when we could have 10% inflation. I think we have to be more aggressive going forward. I know the market's delicate. I know that's a problem. But that's no reason not to take the medicine we have to take to slow the inflation.
Well, Professor Siegel, I mean, certainly not just the market being fragile, but the Fed doesn't have to decide on how many it's going at the next meeting. It just has to do the first one, and then we can wait and see, right? And it doesn't necessarily have to just worry about the markets, but also the idea that what is happening with oil prices at a certain level becomes a restraint on consumer spending and maybe even a break on the economy in itself. So maybe it's going to do some of the Fed's work for it?
Well, I mean, that's true in terms of slowing the economy. But there's two good things to remember about this oil surge. And I know there's been a lot of talk that oil surges have preceded almost every recession in the post-war period. But one has to realize that the U.S. economy is only 25% as oil intensive as it was in the 1970s. In other words, we use 75% less energy to produce $1 of GDP than we did 40 years ago. So certainly it's going to hurt in your wallet and filling up your gas tank. But in terms of total output, it is not as important as it once was. Secondly, we are virtually energy independent. Really, we don't import anywhere near the amount of oil that we did in the 1970s. So that every dollar that goes out of consumers' pockets for higher energy is going in back mostly to American pockets of producers. Now, that doesn't reflect in the stock market because capitalization of energy stocks has fallen so low. But we are still not going to have the impact of these prices as we did 40 or 50 years ago that really caused one of the most severe recessions in the post-war period.